Let me take you back to September of 1992. I was sitting in my office in New York, watching the screens, and I knew that within the next few hours, one of two things was going to happen. Either I was going to make more money in a single trade than most people make in a lifetime, or I was going to be responsible for one of the largest losses in the history of hedge fund management. There was no middle ground, no hedge position, no safety net. I had placed the biggest bet of my career, and the next few hours would determine everything. That trade, shorting the British pound against the Deutsche Mark, ended up making approximately $1 billion in profit. $1 billion in a matter of days. It remains one of the most famous trades in financial history. And today, I am going to tell you exactly how it happened. Not just the mechanics of the trade, but the thinking behind it, the analysis that gave me conviction, the moments of doubt, the lesson that this trade taught me about markets, about risk, and about the psychology of making money when everyone else thinks you are crazy. But I want to be clear about something from the start. This was not luck. This was not gambling. This was the result of years of studying how markets work, how governments behave, and how to identify situations where the risk-reward is so asymmetric that you would be foolish not to bet big. The billion-dollar profit was the outcome. The real story is the process that led to it. Let me start at the beginning. To understand why shorting the British pound in 1992 was such an obvious trade, you need to understand the European Exchange Rate Mechanism, or ERM. This was a system created in 1979 to reduce exchange rate variability and achieve monetary stability in Europe. Countries that joined the ERM agreed to keep their currencies within a narrow band relative to other member currencies, particularly the Deutsche Mark, which was the anchor of the system. The idea was that by linking currencies together, you would reduce uncertainty for businesses trading across borders. If you were a German company selling products in France, you would not have to worry about the French franc suddenly devaluing and making your products uncompetitive. The exchange rates were stable because governments committed to keeping them stable. But here is the fundamental problem with fixed exchange rate systems. They work fine when economies are moving in the same direction. When all countries have similar inflation rates, similar interest rates, similar growth rates, maintaining fixed exchange rates is relatively easy. But when economies diverge, when one country needs tight money and another needs easy money, the fixed exchange rate becomes a straitjacket. Something has to give. Britain joined the ERM in October of 1990. At the time, the British economy was already weakening. Inflation was high, but the economy was sliding into recession. The natural response would have been for the Bank of England to cut interest rates to stimulate growth. But they could not do that. They had committed to maintaining the pound at a fixed rate against the Deutsche Mark. And Germany, dealing with the massive costs of reunification after the Berlin Wall fell, needed high interest rates to control inflation. So Britain was trapped. Their economy needed lower rates, but to maintain the ERM peg, they had to keep rates high to attract capital and support the pound. They were importing German monetary policy at exactly the wrong time for their economy. It was like a patient with a fever being forced to wear a winter coat because their neighbor was cold. I started watching this situation closely in 1991. I could see the contradictions building. Britain's economy was getting weaker, unemployment was rising, businesses were struggling, the housing market was collapsing, and yet interest rates remained painfully high because leaving the ERM was considered politically unthinkable. The government had staked its credibility on staying in the system. By the summer of 1992, the pressure was becoming unbearable. The British economy was in a deep recession. The pound was trading near the bottom of its allowed band against the Deutsche Mark. The Bank of England was spending billions of pounds in foreign exchange reserves trying to defend the currency, and the markets were starting to smell blood. Here is what I understood that many others did not. In a fixed exchange rate system, the central bank promises to buy or sell unlimited amounts of currency to maintain the peg. But unlimited is not really unlimited. Central banks have finite reserves. If speculators sell enough of the currency, if enough capital flees, the central bank will eventually run out of ammunition. And when they run out, the peg breaks, usually violently. The question was not whether the pound would break from the ERM. The question was when. And as I analyzed the situation, I became convinced that when was very soon. The British government had a choice. They could raise interest rates dramatically to defend the pound, crushing their already weak economy and causing massive political damage, or they could devalue, break the ERM commitment, and suffer the embarrassment of policy failure. Neither option was good, but only one was survivable politically. In August of 1992, I started building a position. I began shorting the pound against the Deutsche Mark. At first, the position was moderate, a few $100 million, large by normal standards, but manageable. I was testing the waters, seeing how the market responded, watching for signs that the Bank of England was preparing to capitulate or preparing to fight harder. The response told me everything I needed to know. The Bank of England was defending, but their defense was half-hearted. They were spending reserves, but not aggressively. They were making statements about their commitment to the ERM, but the statements had a hollow quality. The politicians were saying the right words, but their actions suggested doubt. This is a critical lesson about markets. Watch what they do, not what they say. Governments will always claim commitment to their policies until the moment they abandon them. The rhetoric means nothing. The actions mean everything. And the actions of the British government in late summer of 1992 screamed that they were looking for an exit. In early September, I went to see George Soros at the time. I was managing the quantum fund for him. I told him about my analysis. I explained the dynamics. I showed him the math. And I told him that I thought we should increase our position significantly. We were short a few $100 million. I wanted to go short several billion. George listened carefully. He asked questions, and then he said something that changed my life. He said, "That sounds right. But if you are so confident, why is the position so small? If you are right about this, if the setup is as asymmetric as you describe, you should not be betting hundreds of millions. You should be betting billions. Go for the jugular. Go for the jugular." Those 4 words crystallized everything I had been learning about trading. When you have conviction, when the analysis is clear, when the risk-reward is overwhelmingly in your favor, you do not bet small. You bet big. The biggest mistake most traders make is not that they are wrong too often. It is that they are right, but do not bet enough to make it matter. With George's encouragement, I increased the position dramatically by early September. We were short approximately $1.5 billion worth of British pounds. It was an enormous position. If we were wrong, if the Bank of England somehow defended the peg, we would lose hundreds of millions. But if we were right, we would make a fortune on September 9th. The pressure on the pound intensified. The Italian lira, another weak currency in the ERM, was devalued. This sent a signal to the markets that the ERM was cracking. If Italy could devalue, why not Britain? Speculators around the world started selling pounds. The Bank of England spent billions trying to defend. Interest rates were raised. Nothing worked. On September 15th, I watched the pound trade at the very bottom of its allowed band. The Bank of England was intervening constantly. The British government was making ever more desperate statements about their commitment to the ERM. And I knew that we were approaching the moment of truth. That night, I made the decision to increase our position even further. We went from $1.5 billion short to over $10 billion short. $10 billion at the time. This was one of the largest currency positions ever taken by a hedge fund. If we were wrong, it would be catastrophic. If we were right, it would be legendary. I barely slept that night. I kept running the analysis in my head. Was I missing something? Was there a scenario where Britain could defend the peg? Could they raise rates to 15, 20, 25%? And hold on, theoretically, yes. but practically it would destroy their economy and their government. No politician would choose that path. The math was clear. But when you have $10 billion on the line, clarity provides limited comfort. September 16, 1992, Black Wednesday as it came to be called. I was in the office before dawn, watching the London markets open. The pound was under immediate pressure. The Bank of England announced they were raising interest rates from 10% to 12%, a massive increase designed to show commitment and attract capital back to the pound. The markets were not impressed. The pound barely budged. If anything, the rate increase was seen as a sign of desperation rather than strength. Speculators kept selling, the Bank of England kept buying. Billions of pounds changed hands in the first few hours. At 11 in the morning London time, the Bank of England announced another rate increase from 12% to 15%, 15% interest rates in a deep recession. It was economic suicide, and everyone knew it. This was not a sustainable policy. This was a dying gasp. I watched the announcement and felt a strange calm. This was it. The Bank of England had fired their last bullet. If 15% rates did not save the pound, nothing would. And the market's reaction told me immediately that nothing would. The pound fell further. Speculators smelled the end and piled on. For the next few hours, chaos reigned. The Bank of England spent an estimated £15 billion, nearly their entire foreign exchange reserves, trying to defend the currency. Currency traders around the world were selling pounds as fast as they could. The phones were ringing constantly. The screens were flashing. It was the most intense trading day of my career. At 7:15 in the evening, London time, the British government announced they were suspending membership in the ERM. The pound would float freely. The peg was broken. Within minutes, the pound collapsed. It fell from its ERM floor of 2.70, 8 Deutsche Marks to below 2.50, a drop of more than 10%. And our position, our $10 billion short position, was suddenly worth over $1 billion more than it had been that morning. $1 billion in a single day on a single trade. I sat in my office after the market closed, trying to process what had happened. The adrenaline was wearing off. The magnitude of what we had done was starting to sink in. We had bet against the Bank of England, against the British government, against one of the major economies in the world, and we had won. But even in that moment of triumph, I was already thinking about the lessons, because the money was not the real victory. The real victory was the validation of a process, a way of thinking about markets that had led to this outcome. And those lessons have guided every major trade I have made since. Let me share those lessons with you now, because they apply not just to currency speculation, but to any kind of investing. These are the principles that allowed a single trade to generate $1 billion in profit. The first lesson is about asymmetric risk-reward. The pound trade was not a 50-50 bet. It was not even a 70-30 bet. It was more like 95-5. The probability that Britain would stay in the ERM, given all the economic pressures, was very low. And even if they somehow stayed in, our losses would have been manageable because we had sized the position carefully and had clear stop-loss levels. But if they left, which was highly probable, the gains would be enormous. The pound was artificially propped up by the ERM commitment. Once that commitment ended, it would fall dramatically. The upside was many times larger than the downside. This kind of asymmetry is what you look for in great trades. When you can risk one to make 10 and the probability favors the 10, you bet big. The second lesson is about understanding the incentives of all the players. I did not just analyze the economics. I analyzed the politics. I thought about what the British politicians were facing. I thought about what the Bank of England officials were thinking. I thought about what the German Bundesbank wanted. Everyone had incentives, and those incentives were pointing in the same direction. Britain leaving the ERM. The British politicians could not survive raising rates to 20 or 30% in a recession. The Bank of England knew their defense was futile, but had to go through the motions. The German Bundesbank was actually hoping Britain would leave because it would reduce pressure on them to cut rates. When you understand what everyone wants, you can often predict what will happen. The third lesson is about conviction and position sizing. This is what George taught me that day when he said, "Go for the jugular." It is not enough to be right. You have to bet enough to make being right matter. Most investors spread their bets across too many positions. They hedge everything. They diversify away their returns. When you have genuine conviction, when your analysis is thorough, and the setup is clear, concentration is appropriate. The $1 billion we made was not because we were smarter than everyone else. Many traders saw the same setup. The $1 billion came because we had the conviction to bet big when the opportunity presented itself. The fourth lesson is about timing. Being right about the direction is not enough. You have to be right about the timing. If I had shorted the pound in 1990, I would have been right about the ultimate outcome, but wrong about the timing. The position would have cost money for 2 years before paying off, and I might have given up before the payoff came. Getting the timing right required watching for the signs of imminent break, the increasing desperation of the defense, the half-hearted interventions, the hollow rhetoric, the Italian devaluation that cracked the ERM facade. These were the signals that the moment was approaching. And when those signals aligned, that was when to strike. The fifth lesson is about staying calm under pressure. The night before Black Wednesday, with $10 billion on the line, I had to manage my emotions. Fear, doubt, second-guessing. These are the enemies of good decision-making. If I had panicked and reduced the position, we would have made far less. If I had let doubt creep in, I might have closed the trade before the payoff. I managed these emotions by constantly returning to the analysis. The facts had not changed. The setup was still asymmetric. The probability still favored our position. Emotions lie, analysis tells the truth. When in doubt, return to the analysis. The sixth lesson is about being willing to be wrong. Even with all my conviction, even with all my analysis, I knew I could be wrong. Maybe Britain would find a way to stay in the ERM. Maybe the Bank of England had more tricks up their sleeve. Maybe the politics would shift in unexpected ways. This possibility of being wrong was why we had stop losses, why we sized the position to survive a loss, even if it would hurt. The goal is not to be right every time. The goal is to make a lot when you are right and lose a little when you are wrong. If this trade had gone against us, we would have lost money but survived to trade another day. The seventh lesson, and perhaps the most important, is about preparation meeting opportunity. The pound trade looked like a sudden bet, but it was actually the culmination of years of study. They've been analyzing currency markets for over a decade, understood how fixed exchange rate systems worked and failed. I had studied previous currency crises. I knew the history. When the opportunity appeared in 1992, I was ready to recognize it and act on it. If I had not done that preparation, I would have looked at the same situation and not seen the opportunity. Preparation creates the ability to recognize and exploit opportunity. Without preparation, opportunities pass you by without you even noticing. Let me also tell you what happened after the trade. Many people assume that a $1 billion win would lead to celebration, to relaxation, to coasting on success. The opposite happened. Within days, I was back to analyzing markets, looking for the next opportunity. The $1 billion was already in the past. What mattered was the next trade. This is the mindset required for sustained success. Every trade is independent. Past wins do not guarantee future wins. The market does not care about your track record. It only cares about whether you are right or wrong on the current position. I have seen traders make a fortune on one trade and then lose it all because they became overconfident. They thought they had figured out the market. Nobody figures out the market. You just try to find spots where the odds favor you and exploit them when they appear. The pound trade also taught me about the importance of having partners who share your conviction. George Soros did not just give me capital. He gave me confidence. When I was ready to bet big but had lingering doubts, his encouragement pushed me over the edge. Having someone you trust validate your thinking is enormously valuable. It does not mean you should rely on others for your decisions, but it does mean that surrounding yourself with people who can challenge and confirm your analysis makes you a better trader. I should also address the criticism that came after the trade. Many people blamed speculators like us for Britain's exit from the ERM. They said we caused the crisis. They said we profited from Britain's misery. This criticism misses the point entirely. We did not create Britain's problems. Britain's problems were created by joining the ERM at an unsustainable rate, by trying to maintain a peg that did not fit their economic circumstances, by subordinating their monetary policy to German needs. The crisis was inevitable. It was going to happen whether we traded or not. What we did was recognize the inevitability and position ourselves to profit from it. We were not the cause. We were the consequence. And arguably, by accelerating the brake, we actually helped Britain. After leaving the ERM, Britain's economy recovered rapidly. Interest rates fell, growth resumed, unemployment declined. The pound's devaluation made British exports more competitive. In retrospect, leaving the ERM was the best thing that could have happened to Britain's economy. The speculators did not hurt Britain. The speculators revealed a truth that politicians were trying to hide. The peg was unsustainable. The policy was wrong. Markets have a way of exposing uncomfortable truths, and that is ultimately healthy for economies, even if it is painful for politicians. Let me bring this back to practical lessons for anyone watching. You will probably never trade $10 billion against a central bank, but the principles that made that trade successful apply to any investment. Look for asymmetric opportunities where the upside is much larger than the downside. These are rare, but when you find them, bet accordingly. Understand the incentives of all the players, governments, corporations, other investors. Their incentives drive their behavior, and their behavior drives prices. Have conviction. When your analysis is sound, do not diversify away your best ideas. When you are confident and the setup is right, concentrate. Get the timing right by watching for signals that the moment is approaching. Being early is the same as being wrong if you cannot afford to wait. Stay calm under pressure by returning to your analysis. Emotions lie. Facts tell the truth. Be willing to be wrong and size positions to survive mistakes. The goal is not perfection. The goal is making more when right than you lose when wrong. Prayer constantly, so you can recognize opportunities when they appear. The trade itself may take days. The preparation takes years. The billion-dollar trade in 1992 was not a one-time event. It was the product of a process, a way of thinking about markets that can be applied again and again. I have used these same principles throughout my career. Some trades have worked, some have not, but over time, the process has generated consistent returns because it is based on sound logic, thorough analysis, and disciplined execution. That is what I want you to take away from this story. Not the $1 billion, not the drama of Black Wednesday, but the process, the principles, the way of thinking that turns market knowledge into market profits. Because here is the truth about great trades. They do not come from genius or luck. They come from preparation, analysis, conviction, and execution. Anyone can develop these skills. Anyone can learn to see what I saw in 1992. The question is whether you are willing to do the work. The opportunity is out there. Somewhere in the markets right now, there is a trade with asymmetric risk, reward waiting to be discovered. The next Black Wednesday is forming somewhere. The next $1 billion opportunity exists. The question is whether you will be ready when it appears, whether you will have done the preparation, whether you will have the conviction to bet big, whether you will have the discipline to execute. That is what separates successful investors from everyone else. Not intelligence, not information, preparation, conviction, and execution. Get those right, and the results will follow just as they did for me on that September day in 1992, when a single trade made $1 billion. Let me share a few more insights from this experience that I think are valuable for anyone trying to understand how to make money in markets. The first additional insight is about understanding when a system is fundamentally broken. The European exchange rate mechanism was not just experiencing temporary stress. It was fundamentally flawed. The system tried to link currencies of countries with different economic conditions, different inflation rates, different fiscal situations, and different political constraints. This kind of system can work for a while, but it cannot work forever. Recognizing fundamental flaws in systems is one of the most valuable skills an investor can develop. These flaws create opportunities because markets often ignore them until they become impossible to ignore. The dot-com bubble was a fundamental flaw in how investors valued technology companies. The housing bubble was a fundamental flaw in how mortgage risk was assessed. Every major crisis starts with a fundamental flaw that is visible to those who look for it. In 1992, the fundamental flaw was trying to link the British pound to the Deutsche Mark when the British economy needed exactly the opposite monetary policy from Germany. This was not a subtle issue requiring sophisticated analysis. It was obvious to anyone who understood basic economics. But the political commitment to the ERM blinded policymakers to the economic reality. When you find a fundamental flaw in a system, you have the potential for an asymmetric trade. The flaw will eventually be exposed. The only questions are when and how. Violently position yourself for the exposure, manage your risk, and wait. The second additional insight concerns the difference between being early and being right at the right time. Many traders saw the problems with the ERM before I did. Some of them shorted the pound in 1990 or 1991. They were right about the fundamental analysis, but wrong about the timing. And being wrong about timing meant they lost money for months or years before the payoff came, if they even held on that long. Timing matters because capital has a cost. If you are short a currency and paying interest differential for 2 years, waiting for it to devalue, you might lose 20% before making 50%. The net is still positive, but it is far less than if you had timed it correctly. And many traders cannot psychologically handle being underwater for extended periods. They give up before the payoff. I waited until the signs of imminent break were clear. The Italian devaluation, the increasingly desperate interventions, the hollow rhetoric. These signals told me that the timing was now, not later. Waiting for confirmation meant I missed the first 10% of the move, but it also meant I was confident enough to size the position appropriately. There is a balance between waiting for confirmation and missing the opportunity entirely. Too early means bleeding capital while waiting. Too late means catching only the end of the move. Finding that balance is an art, not a science, but leaning toward confirmation rather than prediction has served me well. The third additional insight is about the role of catalysts. Every major market move needs a catalyst. The fundamental analysis can be perfect, but without a catalyst to trigger the repricing, the market can stay irrational longer than you can stay solvent. For the pound trade, the catalyst was the combination of events in early September 1992. The Italian devaluation demonstrated that the ERM was not inviolable. The German Bundesbank's reluctance to cut rates showed that no cavalry was coming to rescue the pound. The increasingly obvious economic pain in Britain showed that the political costs of defending the peg were mounting. When multiple catalysts align, when the fundamental case is strong and the trigger events are appearing, that is when to strike. Before the catalysts appear, the trade is speculative. After the catalysts, the market has already moved. The sweet spot is recognizing the catalysts as they emerge and acting before the crowd. The fourth additional insight is about understanding the constraints faced by your counterparty. In this case, my counterparty was the Bank of England. Understanding their constraints was essential to predicting their behavior. The Bank of England had several constraints. First, their foreign exchange reserves were finite. They could not defend the pound indefinitely. Second, raising interest rates had enormous political and economic costs. They could raise rates, but only so far. Third, The government's political survival depended on the economy recovering, which was impossible with mandated high rates. Fourth, the personal reputations of key officials were tied to the commitment, creating institutional resistance to admitting failure. These constraints meant that the Bank of England's defense was limited. They could throw resources at the problem for days or weeks, but not months or years. And their desperation made their defense predictable. Rate increases, intervention, tough talk, all the standard playbook of central banks defending currency pegs. When they reached the end of the playbook and the pound was still under pressure, capitulation was inevitable. Understanding the constraints of your counterparty tells you what they can and cannot do. It tells you what weapons they have and when those weapons will be exhausted. This knowledge is immensely valuable in structuring trades. The fifth additional insight concerns the importance of having a thesis and testing it. My thesis in 1992 was simple. Britain cannot maintain membership given the current economic divergence with Germany. The pound will be devalued. This thesis could be tested against incoming information. Every piece of news either confirmed or challenged the thesis. Germany's refusal to cut rates confirmed it. Britain's economic data showing deepening recession confirmed it. Political statements about commitment to the neither confirmed nor challenged it because talk is cheap. The Italian devaluation strongly confirmed it. Having a clear thesis and constantly testing it against new information is how you maintain conviction without becoming dogmatic. If evidence had emerged that Germany was about to cut rates dramatically, or that Britain's economy was recovering, or that political will to defend the peg was strengthening, I would have reduced or closed the position. The thesis would have been challenged. Instead, each new piece of information confirmed the thesis, which allowed me to increase conviction and position size. The sixth additional insight is about managing the psychological pressure of large positions. $10 billion is not an abstraction. It is real money that can be won or lost. The psychological pressure of that exposure is immense. I have seen traders freeze under that pressure. I have seen traders panic and close positions at the worst time. I have seen traders become so stressed that they could not think clearly. Managing this pressure requires preparation. Before you put on a large position, you need to have thought through the scenarios. What happens if I am right? What happens if I am wrong? At what point do I know I am wrong and should cut the loss? Having these answers in advance means you are not making decisions under maximum stress. You are executing a pre-planned strategy. It also helps to have support. George Soros was not just a capital provider. He was a sounding board. When the pressure was highest, being able to discuss the trade with someone who understood it reduced my stress. Isolation amplifies pressure. Support reduces it. The seventh additional insight concerns what happens after a big win. The pound trade was a career-defining success, but it was also a potential trap. Success can breed overconfidence. A $1 billion win can make you think you have figured out the market, that you are smarter than everyone else, that you cannot lose. This overconfidence is dangerous. The market does not care about your track record. Each new trade is independent. Past success creates no entitlement to future success. If anything, success makes the next trade harder because you may take more risk than warranted or become complacent in your analysis. After the pound trade, I deliberately reminded myself of times I had been wrong. I reviewed my failures. I maintained humility. This was not false modesty. It was self-preservation. The market humbles everyone, eventually. The only question is whether you humble yourself first, voluntarily, or wait for the market to do it for you, painfully. Let me also talk about how this trade influenced my approach to risk management going forward. The pound trade was a concentrated bet. It worked spectacularly, but it could have failed. And if it had failed, the losses would have been substantial. This experience taught me that concentrated bets are appropriate only when the setup is truly exceptional. Most of the time, diversification and moderate position sizing is correct. But occasionally, rarely, you find a setup so compelling that concentration is warranted. The pound trade was one of those times. But I do not make concentrated bets routinely. They are reserved for special situations with extraordinary risk. Reward. I also learned the importance of knowing when to take profits. After the pound broke, there was more money to be made as it continued falling in subsequent days. But at some point, the easy money is made. The risk-reward shifts. What was an asymmetric bet becomes a fair coin flip, or worse. Knowing when to exit, when the thesis has played out and the edge is gone, is as important as knowing when to enter. Let me address one more topic that I think is relevant. People often ask me whether a trade like the pound trade could happen today, whether the same opportunity exists in current markets. The answer is yes and no. The specific setup of a European currency crisis with a clearly unsustainable peg is probably not replicable. The European Monetary Union has evolved. The euro has replaced many national currencies. The mechanism has changed. But the underlying dynamics that created the opportunity are timeless. Governments making commitments they cannot keep. Policymakers denying economic reality for political reasons. Markets eventually exposing uncomfortable truths. These dynamics exist today and will exist tomorrow. The specific expression changes. The fundamental pattern does not. Right now, somewhere in the global economy, there is a commitment that cannot be maintained, a peg that will break, a policy that will reverse, a consensus that will be proven wrong. The billion-dollar opportunity exists. It always exists. The question is whether you can find it, whether you can understand it, and whether you have the conviction to exploit it. That is the eternal challenge of investing. Markets are constantly presenting opportunities. Most are marginal, some are interesting, a few are exceptional. The skill is recognizing the exceptional ones, having the preparation to understand them, and having the courage to act on them. The pound trade in 1992 was an exceptional opportunity. I was fortunate to find it, understand it, and exploit it, but fortune favors the prepared. The years of studying currencies, economics, and market behavior created the ability to recognize and act on the opportunity. Without that preparation, luck would not have helped. So my final message is this: prepare, study, learn, understand how markets work, understand how governments behave, understand the dynamics of crises. Do this work, not because a billion-dollar trade is waiting for you tomorrow, but because it might be waiting for you someday, and when it appears, you want to be ready. That is the real lesson of the pound trade. Not that I made $1 billion, but that preparation and conviction applied to an exceptional opportunity produced an exceptional result. The process created the outcome, and the process is available to anyone willing to do the work. I did the work. I found the opportunity. I had the conviction. And on September 16th, 1992, all of that came together in a single day that changed my life and taught me lessons I have applied ever since. That is the story of how one trade made $1 billion. And that is the story of how markets reward those who are prepared to seize their opportunities.